What is up, YouTube? Welcome back to Stacks by the Numbers, and I wanted to do another look at a company that was as per request, and we're looking at Archrock Incorporated, ticker symbol AROC, listed here on the New York Stock Exchange. There's a company involved in the oil industry, and we can see the stock actually recently right here hit a new high of 21.40. And the stock right now just dipped below $20 a share, sitting here at $19.99. It's up 15 cents, about 0.75%. Oh, now it's at 20. And we can see that, of course, markets started pumping here in the afternoon, because why not? Let's just keep going higher. But the one thing I wanted to show you here about this stock is we're back at these 9-year highs, basically. You can see the last time this stock was back at around this $19, $20 level, we're looking at June of 2015. We're in May of 2024. So you can see we've had some big swings, and then of course we fell off a cliff there, March of 2020, stock down to $2, and then runs all the way back to 10. We can see a little consolidation here, back down to sub 7, and now boom, we're back up to 20 again, hitting that high of 21.40. Now, overall, in my opinion, this company actually has been growing very nicely, and the EPS side has actually been a little bit of a struggle here. If we go back and look at a lot of these quarters, we can see we have more EPS misses back in the day, and it seems like recently they kind of righted the wrongs a little bit, but the revenue for the most part has been climbing very nicely. I cannot deny that, and we're actually back above pre-pandemic levels here, right? So we're coming out mixed, then all of a sudden we have a good quarter, but for the most part, the revenue was coming in above expectations, even though the EPS was missing by a little bit, right? And then you have a slight flip there with a very, very tiny miss. Beat top and bottom line. Again, miss on the EPS, but the revenue has been coming in very nicely. Look at that, 247.5 on estimates jumping up to over 240 million. So they beat that kind of milestone 240 plus million mark. Beat on the EPS side as well. Next quarter, boom, up to 253, over 252. Beat on the EPS side. And again, slight miss on the EPS side. Boom, look at that revenue up to almost 260 million. And now, boom, look at last quarter. This came out the end of April, only about 2 weeks ago, April 30th. Company comes out, posts 26 a share on estimates of 22.3 cents, and posts almost 268.5 million on estimates of 260.5 million, beating by about 3%. So you'll see when they do beat the earnings estimates on the revenue side, they're beating by 2, 3, 4%, not necessarily in line. And of course, the EPS has been swinging, but looking at the growth in revenue over the quarters and over the last several years, in my opinion, I can completely appreciate the fact as to why this stock has been climbing. And on top of it, we're going to look at the fundamentals in a second. Practically every single fundamental metric across the board has been increasing quarter over quarter for the most part. So this company really is rocking and rolling. And I just wanted to show, I know it might be hard to see, but see back here, this is 2012 going into 2013. See how we had a massive run up? Then it looks like we hit about, it looks like about 1970. I have it marked at 1969, but right around that level, you can see that's where a big drop and rejection took place here. And this was on a beat on the top and bottom line. Then you can see it flattened out, chunked up next quarter on an EPS beat, but a big revenue miss, chunked back up to where it was, danced around the trend line, and then exploded and broke up through it to new 52-week highs at the time, right? And then even as we started to sell off here, you can see, look, it's coming down, testing, trying to bounce off this trend line. Then it drops below it, but it tries to reclaim it. Big rejection. Comes back up here, coming into earnings. Earnings are light, so it drops back down, but tries to retest it, gets above it, right? Look at this. At earnings, tries to retest that trend line again. So in my opinion, it looks like there's a lot of action around there. I'd say maybe somewhere like 1970 to, like high 19s. That looks like, in my opinion, a pretty key level. And we can see now, if we zoom in, we can see that we recently, look, we tried to get above it. We stopped right at it right there on that candle. Then we broke up above it, coming off of this strong revenue coming in from the previous quarter. Then you can see we dropped down below it. Look, and immediately got back up, got above it, came down to retest it, bounced off it, broke below it, broke back above it, and now we're coming down and we're retesting it again. So that right there looks like a key level in my opinion. And of course, we have our top trend line connecting the tops from April 4th going down to May 7th, I believe. That's just kind of connecting across the tops. This is now our resistance trend line. We have to get above, right? And these are just basically some support levels. I drew out a trend line here from the low, looks like September 26th of 22, connecting to that low there of May 3rd, and that's just cutting across those lows. That's this line. And then I have the next line here going from these lows, looks like May 31st of 23. And that's kind of coming up to that body right there of those lows in the first week of July of 23, connecting to that low right there, October 5th, connecting across to those lows. And that's this line coming across here. Let me actually try to change up some of the colors here. There we go. And now we'll make this one like orange or something. But yeah, now if we zoom in, you can see now from the previous low after that, January 11th, 24, I went from that low and I came across and I cut right to the bottom of that candle there on April 30th, 2024. And you can see that this was yesterday. And you can see, look at the body of that candle. Look at that. The bottom of that body right there at the trend line, right? And then we broke back, slightly got below this key level that I mentioned around 1970, in my opinion, on my screen. We slightly broke below that 20-day moving average, and then we popped back above this trend line and this trend line. And now we're kind of back in this little triangle range here. So we do have potentially a small little symmetrical triangle forming right now, and symmetrical triangles technically kind of undefined, right? We could either break up or we could break down. And in my opinion, I mean, of course, it could go either way. Based on the fundamentals, in my eyes, I would assume and potentially predict that it should break up. But of course, we can potentially, as we see with the bouncing around this roughly 1970 level, we can potentially break down, come down to this trend line maybe about like 1880, and then we can bounce and try to retest this 1970 and kind of bounce around in here, right, before maybe taking the next leg higher back above into the 20s. So only time will tell, but let's get into the fundamentals real quick, because we have a market cap here, 3.13 billion. We're getting paid a dividends, yielding out 3 1/3%. PE about 24. That's about middle of the road for this stock. Look at the beta as well. The beta, again, is the volatility of a stock in relation to the overall volatility of the market, meaning that this is technically like 92% as volatile as the market, right? So slightly less volatile as the overall market. But look at some of these numbers here. The EPS has been climbing nicely. And again, I told you recently, they kind of turned that around and righted the ship. And we can see that they've beaten on the EPS side now 3 of the last 4 quarters. And it seems to be consistently increasing. Last quarter posting 26 cents. This quarter coming up at the end of July. Estimates right now pegged at 26 cents a share. But look at annually here. 965.5 million in 19, right? Then 20 was a rough year for everybody. Revenue dips down sub 875 million. Dips down to 781.5 million in 21. And then look at the rebound here, not only with the profitability, but the revenue as well. Chunking right back up to 845 million, right? Almost back to where we were in 2020. And look at 2023 now, 990.3 million. We go back to 2019, 965.5 million. So this is a little bit of a different story when compared with something like Limbach Holdings, which we just looked at in a previous video. And we can see now that the revenue has not only gotten back to pre-pandemic levels, but has actually eclipsed where we were before lockdowns took place. So, in my opinion, this stock looks really good right now. And also the profitability as well. Look at the net margin here, 9.94%, right? We dip down. As we start to stage the comeback, we get up to about 3.5%. We get up to a little over 5%. And now for 23, 10.41%. So now we have higher revenue, higher income, and higher profitability from pre-pandemic level of 2019 here for 2023. So I can completely appreciate the fact as to why this stock has been on a tear. And if we switch over quarterly, it looks even better. Look at this, 229.83 million, 247.5, 253, 259, 268.5 million, consistently increasing that revenue quarter over quarter, and of course the profitability following suit as well, sub 7%, up here to almost 10%, 12%, 12.5%, and now up to almost 15% for last quarter. So in my opinion, a lot of these numbers are on the up and up. And I feel that this growth is not only justified, but I feel that this current stock price, in my opinion, this value could very well be sustained. And that's why I'm saying if we kind of even break down out of this triangle, but then kind of rally back up and run to new highs, in my opinion, it would be justified. And if we look at the annual revenue, again, 990 million, market cap 3.13 million. So we're trading only like a little over 3 times annual revenue right now, and we can easily take this to maybe 3.5 and maybe even 4 times annual revenue, which of course would be roughly like a 30% move from here. So we'd be looking at like a $26.5, $27 stock. That may come in due time, and it may take a couple of quarters for them to continue to show that revenue is still remaining strong and beating estimates, and we're on the up and up and everything's great. So obviously it's not really going to happen overnight, but in my opinion, if this slowly ticked up and we saw the market cap, in a month or two, all of a sudden we're at like 3.3 billion, 3.45 billion. In my opinion, that would actually make sense, even though the PE is kind of middle of the road here for what the company has been reporting. But let's look at some of these numbers here. So the dividend here, you can see 55 cents jumps up to 58 for 3 years coming out of that lockdown. And now for 23, they upped it again to 61 cents. In my opinion, that's a very good sign. Let's look at the debt here. 186 billion, 17, 15, 15, back up to 16 slightly. Not necessarily a big deal. Let's look quarterly here. 156, 165, 162, 16, 158. So the debt technically has been ticking down for the last 4 quarters in a row. The free cash flow, you can see, was positive about 3.5 million, drops down negative 72 million, and then 45.5, 35, 38. So basically kind of just staying around those high 30 marks, but at least it's back positive, right? The cash, the problem is, we spoke about this recently in a previous video, and we were talking about the rising interest rates and the fact that tech stocks, in my opinion, are remaining solid because they're the ones with the highest profit margins, and they have some of the most capital liquid cash on hand, right, to deal with these headwinds. So with this company right now only holding a little over $1 million in cash, in my eyes, that could be a potential slight issue. But in the moment, I really wouldn't raise too much of a red flag because, again, the revenue consistently keeps increasing and the profits that they're making off of said revenue continues to increase as well. Their gross margins, the operating margins consistently are increasing quarter over quarter. So I don't know if I would necessarily really view that as a red flag. It's close here in the short term, but we do have assets outweighing liabilities and assets outweighing liabilities in the longer term as well. Let's switch over here to our income statement, and look, we just have nothing but green here. Very, very impressive in the fundamentals in AROC right now, in my opinion. Look at this revenue, again, consistently increasing, and look at the cost of goods sold. I mean, we jumped up to the low 150 million, and we've essentially kind of maintained that level, give or take, 2 million in change here over all these quarters, and that's a very good sign, because if the revenue consistently increases, but you can keep your costs in line, what does that do? Total revenue minus cost of goods sold yields gross profit. And you can see the gross profit is climbing very nicely over all these quarters here. 65, up into the 70s, jumps up to 95, almost 100. And now the last 2 quarters, 104.6 million. Last quarter, almost 113 million. So all of these numbers across the board moving in the right direction. Operating expenses jumped from the high 20 million mark again, give or take maybe 4 million, jumping up to 33, 31.67. But again, we technically generated several million, about 9 million more revenue. Cost of goods barely moved. Profit increased by about 8 million. But we can see operating expenses actually dropped by about $1.5 million. So this is what I mean. It really does seem like this company is rolling on all cylinders right now. And gross profit minus operating expenses yields operating income. And we can see the operating income, just looking back here, roughly about, 7 quarters ago, we have more than doubled our operating income. And you can see we're up here at the high 35 millions, 39, almost 50, 66, north of 70, maintaining 71. Last quarter, 81.25 million. And if we go back again, roughly 7 quarters ago, we were at 35. So this operating income over the last 7 quarters is now up roughly 133% over this time frame. Very impressive, in my opinion. So this company, really seems to be looking well. Look at the assets here, just holding like this 2.6 middle of the road, 2.6 billion mark here. And the liabilities as well. You can see it slightly ran up here from the mid 1.7s up to the low 1.8 billions, and now pulled back to the high 1.7 billions. But just look at how flat, quarter over quarter, unchanged on the assets and liabilities. Very impressive, in my opinion. Total assets minus total liabilities yields total equity. And we can see the equity up here at 869 million, dips down to the 850s, and has since been climbing now 1, 2, 3, 4 quarters in a row, getting back up to 882 million. That's the highest the equity has been, going back the last 7 or 8 quarters. And we can see the book value per share up here at 559, dips down to 544, and has slowly been climbing up a couple of cents each quarter now, about 5-6 cents a quarter here, jumping up now to 564 as of last quarter. So yeah, technically we're trading a couple of times that book value. However, again, a lot of these metrics really moving in the right direction. So for a company like this is what I mean. When we look at kind of like a mixed stock or a stock that only goes higher, and all of a sudden we turn around and now we're trading like 18, 24 times book value, it's like, yeah, in my opinion, those stocks are probably due for a sell-off. A company like this that's consistently growing and on the up and up here, increasing all of these numbers quarter over quarter, to be trading, 3-4 times book value, in my opinion, that could be viewed as undervalued and actually cheap. But again, that's just my opinion. But you can see, look at the PE here, 25.5. We got up above 30, but we're maintaining like this mid 20 range here, 26, 24, 24, 23, 24, and now 24.15. So we're basically in line with where we've been. And of course, as the earnings increase, the PE will technically drop down if the stock doesn't move, right? And then when it potentially looks more attractive, that's when it may take the next leg higher and get back to a PE of 25.5, 26 or whatever. You understand? Price to sales, as you see down here in the low ones, consistently increasing quarter over quarter like clockwork, up to about 3 times sales right now. That technically is the highest it's been, but it's not a crazy multiple in my eyes. Price to cash flow, we could see a slight dip here back to sub 7 and then right back up, and we jumped into the 8s, got above 8.5 times cash flow right now. Again, that in my opinion, that may be the one issue, the fact that the free cash flow was kind of bouncing around, up and down, seesawing, and right now the company, as of last quarter, only having about 1.1 million in cash on hand. So that technically, in my eyes, may be the few little speed bumps, but overall, I'm liking this one. I have to be honest. Price to book. Look, we were trading basically in line with book value and just consistently started to run up this ratio, of course, because the stock went higher, right? Book value was moving a couple of cents a quarter, but the stock was raging this whole time. So now the ratio gets higher, but we can see we're only trading about 3.5 times book. And for a company, again, on the up and up with a lot of these metrics increasing, that could be viewed as cheap. It could be viewed as cheap, but it may not run too much because of the PE. Right? So if we chunk this stock up, let's just say a quick 25%, boom, now all of a sudden the stock's at $25 a share, we're at new highs. The PE moves as well, right? Because that's the price to earnings ratio. That's the stock price divided by the EPS. So now the PE, right, a quarter of that would be, 6. So the PE would immediately jump up to 30 if the price runs to 25, you understand? So that's why I'm saying it may not move too much in the moment, and it may wait until next quarter. If they beat again and show growth again, then we can chunk up, the PE to 27, maybe 28, and start heading towards the high 20s, potentially getting back to that 30 plus mark again. But again, that's just my opinion. Enterprise value, again, we just mentioned it, it's here on the list, but enterprise value, technically what another company would be willing to pay for this stock. You can see now the enterprise value up to $4.68 billion. So that's about $1.5 billion higher than the current market cap. It's roughly 50% more than where we're currently valued at right now, which would be about a $29, $30 stock. So this is why I'm saying we can potentially have more growth here coming. Our return percentages are up, assets, equity, return on invested capital, all up. Look at the gross margin percentage. 30, 32, 33, 38, 39, 40, 42 as of last quarter. Nothing but up and up. Stock should be climbing, in my opinion. This is justified. Operating income essentially doubled over the same period here. 16.7, high 17s, middle of the road 21, almost 27, almost 28. Slightly back down to 27.58, and then back up to north of 30 and a quarter. That's the highest it's been. Again, going back the last 7 or 8 quarters, we have now almost doubled our operating margin percentage. Very impressive, in my opinion. EBITDA, earnings before interest, taxes, depreciation, amortization. We can see we had a slight dip here from 38 down to 36, and then we were off to the races here. 39.5, 40, almost 44, almost 45, back down to 44, and now up to over 46.5%. And the net margin percentage we looked at before, dancing around a little bit here in these mid to high single digits, getting up to almost 10, and then 12, 12.5, now almost 15% as of last quarter. Inventory turnover does pop and drop a little bit from quarter to quarter, but we can see we were at 7.5, 7.4, we go down to low 7s, back up to 7.4, now we're at 7.2. But again, in my opinion, I don't know if I would really even view that little dip as a negative, because the company is again doing great business and is consistently growing nicely and coming in well above revenue estimates quarter over quarter consistently for the most part. So that's why something like an inventory turnover, unless that dropped down to like a 4 or something and the company cited like, you know, supply chain delays or something, in my opinion really shouldn't be an issue. Asset turnover is the amount of revenue the company is able to generate off of said assets on its balance sheet, and you can see that is up very nicely here, going from 0.31 to the mid 0.3s, now up to almost 0.4. So this number has risen almost about 30% over the last 7 quarters we're looking at. Our debt to ratios were going up and came right back down basically to where we were here about a year and a half ago. Same thing here, debt to equity ran up here 193 and pulled back to the 17s where we were almost. Yep, same thing for the most part across the board. Yep, dividend holding steady. Remember, a lot of people had to cut their dividends, or they waited until like 2022, 2023. It took several years for some of them coming out of that lockdown to reinstate the dividend. And AROC was able to hold and maintain that dividend and actually recently increased it for 2023. So in my opinion, it's actually a very good sign. It shows that the company is able to take on that dividend, right? And knows that they're basically going to remain solid and stable, and you know, it's not going to be an issue. But the EPS side, again, as we said, they're kind of coming out of the doldrums here from almost this flatness a while back, and now we're starting to climb up. We're earning over a quarter a share, and you can see moving forward, looking to maintain that profitability. 26 cents a share, 27, 28, 29, moving into tail end 24, going into 25. We have 3 misses, a meet, and 4 beats. So again, the EPS side has been a little inconsistent, but it's the steady growth in revenue, in my opinion, that is eclipsing the profitability side. Because again, I feel like it's not a big red flag missing by, you know, a cent or two here or there, because as I said, the company was able to maintain its dividend and recently increase it. So that's why, with the revenue growing and the net margin increasing along with it, I feel like people aren't really viewing a slight miss on the EPS side as a red flag. But that's just my opinion. But it does seem that way, right? But if we look at the revenue side here, I mean, absolutely rocking and rolling here. Even when they missed, look at that, by less than 0.5%. But look at how they beat, right? This was the smallest quarter here at 0.5% beat. But before and after, look, you know, we're talking 2.4%, 2.6%, 3%, 4.7%. So this is what I mean. Not only are they beating earnings, but they're doing so 2, 3, 4% in change, quarter over quarter, consistently like clockwork. Very, very impressive in my opinion. We switch over here annually as well. Look at that. Slight miss in 2019, and then during lockdowns, they came in above annual estimates. And then the year after, and came out looking even better and better. Again, with this revenue getting up to almost $1 billion, higher than where we were before said lockdown. So in my opinion, this is actually a really, really good sign. This company looks very solid in my eyes. And, you know, if you wanted to slowly build a position here, and you're telling me that you're looking for like 28 a share, you're looking for like 30, 32 a share, you know, over the next 6 to 12 months, in my opinion, I would actually agree with you. And long term, I think it might even go even higher. Estimates for 2024, look at that, now breaking up to above $1 billion, 1.09 billion. Very nice, in my opinion. And then getting up to 1.16 potentially in 25. And if we look at the EPS side, again, you can see, look, they've been missing slightly, but they have technically been missing for the last 4 years in a row on the EPS side. But the revenue has come back like an animal. So that's why, again, I think that the EPS, I really don't think it's viewed as an issue right now. But more importantly, moving forward, they're really going to increase their profit margins here, it looks like, going into 24 and 25. Because, again, you can see we're looking at what, like $100 million increase year over year from 23 to 24 on that revenue. But look at the increase in EPS here, from 67 to 107 to 126, off of about 150 million more revenue over the next 2 years. So they're expecting almost to double this EPS number just in the next 2 years. So if this stock is able to maintain this revenue, consistently come in above estimates like they've been doing, and somehow double up that profitability side, I really do believe, in my opinion, we can easily be looking at a $30 stock. Easily. But again, that's just my opinion. But you can see aftermarket services, not really back to where they were, but the contract ops well above 800 million now, going up from 600 million here, 2017. So what's that, like 6 years? Have a nice rise there of 33% over 6 years. Again, it may not seem like a lot. It seems like a lot of time, but again, talk to people in the comments section. People who own businesses. And, even sometimes if you see 3, 4, 7% growth year over year, it could really add up. And it's the average in a lot of sectors, in a lot of industries. So that's why when we look at companies like Fubo, perfect example, right? We always look at, they recently took a hit last earnings because the subscribers were up 22%, but they were forecasting 25.7% or something like that. It's like, do you have any idea how difficult it is to grow your audience, to grow your business 25% in value year over year? That's why I'm saying, if you guys don't own a business, I'm not knocking you, but do me a favor, inquire in the comment section down below and speak to business owners and ask them how much a 25% growth in your business year over year, how difficult it would be to see something like that. So that's why, in my opinion, it seems like the forecast looks good, stock looks good, and again, the stock recently broke below both of these key level trend line here of about 1970, and of course our little support trend line here we broke down, and now we're back in here. So over the next day or two, we can potentially break up or down. In my opinion, I like it here at 20. And if it does drop to this trend line, let's just say like 1880 or something, in my opinion, I would like it even more. And also, if it happens to approach the apex and then break up and hit new highs, in my eyes, I would not be shocked at all, because a lot of those numbers are extremely impressive. But let's switch over here real quick. We can see we have a resistance level here at 2062. Yep, it looks like we paused there a couple of times. And the next pivot point here that we're bouncing off of, potentially 1964. What did I say? About 1969, 1970, that line I was looking at. So we're right around the range here. But look at this 50-day here going from October down here from about 12. Now it's up to 19 and a half. 200-day moving average wasn't even on the screen here. Mid-December, down here at 11. Now it's up to 15 and a third. But I will say a couple of things. The RSI was up, right? Now it's kind of bouncing around, dancing around the middle of the road, sitting here at about 53.8. And the MACD also potentially curling and trying to cross to the downside maybe. So we can have a little pauseness maybe for the next couple of days, and we may potentially retest right around that 1949. It may retest that moving average. But looking back over the last couple of months, look at this. Even during October, if you recall, this is when like the sell-off was still happening, and then we didn't rally until November. But you can see the stock basically flat, right? It was above the moving average, broke below it, got right back above it, stayed above that pivot point right there, danced around the moving average, and then when market started to climb, the stock just started to take off. So you can see that it retested right at the beginning of November. It retested that 50-day, retested here right after the ball dropped, but bounced up. Retested here, looks like second half of April, but bounced up. going into May right here, we had the retest, strong red candle down, and then nice big black candle back up, and we could potentially retest again. But in my opinion, again, based on the growing metrics that we looked at, it really should technically bounce up off of that moving average again. Here on the weekly, top resistance level 2070, and we hit 2140 and then kind of calm down. And this is what I mean. We could kind of flatten out and then potentially break out of this triangle and try to retest this high 20 level and then maybe get back to those new highs and retest them again. But as you see, the RSI was on the up and up here, well above 70 here for months technically, and has since pulled back right around to that benchmark of 70 you can see the last week or two, and now broke below 70, sitting here at about 69.5 on the weekly. So that's why, again, I always say, in my opinion, much more advantageous to piece your way in. You don't want to go, in my eyes, you don't want to go all in here at 20 and then have it pull back to this support level of 1791, right? Instantly going to take a 10% loss. Now, over time, you may be fine, right? But we know that it'll probably piss you off, and you're going to sit there and say, oh, I knew it. I should have remained patient. I could have bought more shares. I could have had a lower cost. It would have been better. So that's why, in my opinion, you want to piece your way in here after this massive rally. And then even if it does slowly start to tick down all the way back down to 15 and meet up with this 50-day moving average, again, in my opinion, if we liked it at 20 and we can add here at 18, we're going to love it even more down here at 15. So that's why I say, in my eyes, much, much less stressful to build a position, accumulate shares, try to bring that cost down, and play the long game as opposed to the short game. And I know you guys with real wealth out there, you guys who have multi-million-dollar accounts, I know you're the ones who really appreciate my perspective a little bit better, because obviously the more you have, the more you stand to make on big growth. And then, of course, taxes are your enemy. So you want to pay the least amount of taxes as possible. So if we can find these moves of 50, 80, 150% over 12 plus months, not only are you going to be able to kind of secure that growth, but you're also going to pay half the amount in capital gains tax, which of course would make every millionaire happy. But we can see here on the weekly, the MACD potentially crossing to the downside now, which is why we may potentially actually end up breaking down out of that symmetrical triangle instead of up. But again, a dip back down here to like sub 18, in my eyes, it should be very short-lived. It should be, in my opinion, unless they want to beat it up for not having much cash on hand. But again, in my eyes, they probably would have done that already, in my opinion. So RSI, again, may just kind of come back down here into the 50s, and we may kind of slowly fizzle down here before popping and breaking up higher. But overall, I really like it. I spoke for too long, but we'll check the Bollinger Bands real quick. And you can see if we happen to break up now, our Bollinger Bands are climbing nicely here in this channel. Top Bollinger Band up here, slightly above 22 right now, 22.02. So if we do happen to run up, we could, of course, hit new 52-week highs there, but we can see the mid-Bollinger Band here, 1811 as well. So we may potentially have a pullback to the high teens before popping back up into the 20s and making those new highs. But it does have these big pops, and then we have these slight consolidation zones, and then we pop big, right, and run, and then we pull back slightly. So in my opinion, this stock is actually trading and running healthily. And you can see that because the Bollinger Bands, this was the biggest trumpeting, and then you can see it's just kind of rising with the top Bollinger Band. So we're just in this nice steady upward channel, right? We don't have these big swings. So in my opinion, this is actually trading correctly. But again, slightly high RSI, and we did have a big run. So a pullback can happen. A pullback can happen. And on the daily, look, we have a tightening here on the Bollinger Band. This is why I'm saying we may kind of just remain flat, maybe retest this at 19.5, try to bounce below it, get back above it. So we could kind of hang out here for a little bit. And once we tighten up again, we can potentially take that next leg higher. But yeah, you know, if you're telling me, oh, over the next, like 3-4 weeks, you're expecting it to go from this level to new highs of 22, and you're looking to make like 10%, in my opinion, I would agree with that. I would completely understand where you're coming from. So yeah, you got to keep an eye on those moving averages, a lot of those pivot points, and of course the RSI on the weekly. But that's pretty much it. AROC, AROC on the New York Stock Exchange on the up and up with some very impressive growing metrics here over time. And definitely one to keep an eye on, in my opinion. And I'll end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel, right? And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky and volatile and very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Have a good day, guys.